Well, hello, traders. It's Friday, September 13th, and I've got news for you. China and U.S. are starting to, it looks like there's promising things starting to happen. China to lift punitive tariffs on U.S. soybeans and pork. Look, it's a start. It's a start. Hopefully, this is the beginning of something permanent. All right. I would hate to see U.S. and China break off trade talks because it would put us back to square one. Don't want to see that. So, how is the stock market reacting to it? What sectors are going to rise and fall? Let me show you something really interesting here. This is a cumulative strength index. This is the top sectors in the S&P. Right now, technology and consumer discretionary are leading. Those are the two most speculative sectors in the S&P 500 out of the 10 or 11 sectors if you want to use telecommunication as a separate sector. Some consider that a separate sector. Some just put that in tech. I put it in tech. So I have 10 major sectors. But look at this. This is really interesting, and this is very puzzling. Consumer staples and utilities are the most defensive sectors in the S&P 500. Typically, when you see technology and consumer discretionary lead, you see consumer staples and utilities lag. They're the last ones, okay? You hardly ever see the most defensive sectors next to the most speculative sectors. That's not a bullish sign. That's a big warning sign. Let me show you something. This is the chart of the utilities. They're near all-time highs right now. Look at technology. This is tech. We made all-time highs back around July, okay? And this is utilities, the most offensive and the most defensive sector. We just made all-time highs less than 10 days ago, okay? So defensive sectors are still leading. Don't get fooled into this market. It's slightly bullish, but at any given time, it can turn on a dime. That's why I'm still defensive. Put the call ratio just turned. That means the market is cooling off. That means the odds of seeing more buying pressure are not that high. Moreover, let me show you the broad market. Let me go to my dashboard here. I want to show you something. So if we look, let me give you my settings. I want to show you my settings here. You could never find anything when you're looking for it, right? Notice small caps, which have been leading the market higher last few days, they're grossly overbought. And if you look at the S&P, let's look at the E-mini here. It's also grossly overbought. And it's not even leading higher yet. The high is around 3028, 3030, and we're still at around 3020. And if you look at the SPY, we're a little bit higher. We're at new highs right now, but look at this RSI. I mean, it's overbought. So more likely than not, I'm expecting the SPY to come down to the 50-day moving average or go back lower, and I'm expecting utilities to start picking up or the bond market to start leading again. That's the 50-day moving average right here. It's right at the 50-day moving average. It's oversold, and it looks like it's ready to move higher. Bonds move higher when stocks move lower. So in my opinion, stocks are grossly overbought. We're going to see that stretched out rubber band effect when they move back to the 50-day moving average. And defensive stocks like utilities or ETFs like bonds are going to start leading the market higher. Keep your eye out on gold and the bond market. Next week, I'll give you guys a good overview of what particular stocks to look at. But for now, look at defensive stocks like Costco, Target, stocks that are not related to China. Because again, what we're seeing right now, I'm not seeing anything too substantial. Pork, giving up tariffs on pork is not a big deal. I want to see tariffs given up on tech stocks. All right? We'll talk soon. Bye.